We have just received new information, new data, new signals that suggest that one of the biggest bearish catalysts that have been an overhang on markets is finally starting to dissipate, and that is falling inflation. But as we're going to talk about in today's video, that may only bring temporary relief, as that's just one macro worry, and the bigger elephant in the room is the upcoming earnings season. Look at this. The next 30 days will absolutely be critical, as 87% of the S&P 500's market cap names will have reported by May 5th. And that means we can expect some outsized moves over the next 30 days. We can also see that the financial stress index is approaching key inflection points not seen since the dot-com bubble and the long-term capital management episode before the 2000s. This is all happening at a time when the credit crunch could be coming after consumers in the upcoming weeks and months. We can see here that the share of households reporting it is harder to obtain credit than 1 year ago is essentially near a multi-year high. And because of this, commercial real estate continues to be a major focus point on bank stress, as the share of U.S. office space that is now vacant in 50 largest metro areas is surging to a multi-decade high. In the context of the macro situation and the fundamental situation, hedge funds, they are determined to target downside in the markets with historic conviction. They are shorting the S&P 500 E-mini futures with a largest net short position since essentially a decade ago. Whether this will turn out to be correct for them, we will see, but I think that hedge funds may be onto something here as we approach earnings season. Now, some analysts think that the Silicon Valley Bank episode may just be the beginning. We'll soon find out as banks report soon. Now, make sure to follow me on Twitter for further thought leadership on markets, the economy, and life perspectives. I recently wrote this. I said, in investments, we can do one of three things to excel: be the smartest, be the first, or be the most patient. And as mere mortals, I think that number three is something that we can all aspire towards, because sometimes 1 and 2 are not within our control. I also wrote about how the recent strength of two key names that I've advocated for inside our investment community really tell us all we need to know about the US consumer, and that's Dollar Tree and Dollar General. The strength of these two names tell us that a consumer trade down is coming. I defended these names during their latest sell-off when they were trading at 135 and 205 respectively. Now they're above 150 and 215. Remember, these moves are a multi-week, multi-month process. Now also join me on Substack along with my other friends on the platform. I expect this earnings season to be challenging, but I will do my best to help our friends navigate it. Protect yourself for what's coming up ahead. Look at this, guys. We can see here that recently we received a very strong jobs market report. The unemployment rate came down to 3.5%. On the surface, all looks well. But when we look underneath the hood, we can see that most of the jobs being created are in sectors that are primarily part-time in nature. And the white-collar recession is still largely in play. The reality is that a credit crunch is something that many people aren't prepared for, because as we can see here, with pandemic savings long gone, Americans are carrying record debt loads in February and beyond. And with commercial real estate about to feel the heat of the higher for longer narrative, we're going to see how well banks are going to hold up in the upcoming earnings season, because real estate stress in the commercial property sector will be felt the most by the regional banks, and banks are reporting imminently. When we take a look at the small business outlook, the trajectory does not particularly look constructive. As we can see, the small business optimism index is essentially at a multi-year low. And in a survey about whether it is a good time to expand, small business owners say that they're not really ready, and essentially they say no, they're not ready to expand. This is important because small businesses, they comprise of most of the hiring that happens in the US. And with the jobs market about to significantly weaken from here, the US credit crunch could be going after S&P 500 EPS either this quarter or next. Going into this earnings season, we're looking at revenue growth forecasting being weaker nearly across the board, across every single S&P 500 sector, and so are the profit forecasts for many of the sectors in the index as well. One of the biggest drivers of corporate profits is employee productivity and your own personal productivity, and today's video partner is going to talk about just that. Now, one of the things that you can do to maximize your productivity when you work is to have an autofill password manager that syncs with your browser so that you don't have to constantly recall passwords. This brings us to today's video partner that can increase your productivity, Dashlane. Dashlane is powered by patented security technology and machine learning, which is why it consistently ranks as the best password manager available. No matter the device or browser you're using, it makes every shopping experience a one-click checkout, stores all your passwords so that you're never locked out of an account, and provides a VPN for streaming content and secure browsing. Dashlane is the ultimate password manager and digital wallet that takes the hassle out of online security. With Dashlane, you can store all of your important passwords and sensitive information in one secure location and accessible from anywhere on any device. And the best part, Dashlane's password generator can create strong, unique passwords for you so that you don't have to waste time coming up with them yourselves. Plus, their digital wallet makes online shopping more convenient and secure than ever before. With Dashlane, you're not just investing in your security, you're investing in your peace of mind. To try it for free on your first device, go to dashlane.com/Larry and use my promo code Larry to get 50% off if you want to upgrade to one of their paying plans. So what are you waiting for? Simultaneously upgrade your online security and increase your productivity with Dashlane. Now, back to the video. We can see here that the jobs openings in the US have fallen by 2 to 3 million from their peak in early 2022. So with fewer than 10 million jobs available and open in the US, it could start to become more challenging to find meaningful employment going forward. On top of this, we're starting to see signs of deflation that may be taking hold, with money supply growth now negative. If we take a look at the US M2 money supply year-over-year chart, the money supply has never actually gone into negative territory over the last decades. This is implying that deflation could be taking hold in the upcoming months and possibly 12 to 18 months ahead. We can also see that the Freightos Baltic Daily Index for transportation costs, it has absolutely plummeted. This implies that there could be weak global demand coming ahead. Now, the recovery that we've seen in the stock market, especially the NASDAQ, is not really on an equal footing, and it's primarily driven by a handful of companies. As we can see here, as the NASDAQ 100 continues to rise, the number of NASDAQ 100 stocks above their 100-day moving average is actually continuing to fall, and that divergence could be trouble as we enter the earnings season. If we take a look at the AI regulation that the Biden administration is starting to look at, this could deflate the AI trade given the current valuations. This is key because critical names such as NVIDIA, Microsoft, and AMD, they have strongly held up the index, and the index largely depends on their outperformance. And if AI models have to go through a certification process before they're released, this could potentially curb growth, and this is exactly what the Biden administration is looking at. If we look at this chart, the S&P 500's 2023 performance has largely been attributed to 10 names out of the 500 names in the index: Apple, Microsoft, NVIDIA, and the rest of this list. The other 490 names really have contributed less than 5% of the gains, which means that the breadth is not quite healthy. So the importance of big tech has never been larger in the S&P 500 relative to history, and this could be setting up the index for a massive trap in the upcoming weeks and months. We can also see here that the rolling one-year correlation between the S&P and the US aggregate bond index is actually approaching multi-year highs, which means that in the next sell-off, even bonds may not be able to escape despite their outperformance this year. Now, the good news is this. The good news is that stock selection is going to work in this environment because of a lower correlation among stocks. If we take a look at this recent chart made out by Goldman Sachs Global Investment Research, they put out a correlation of stocks within the S&P 500 that has declined sharply. And that's good news for analysts who are able to identify good companies at the right valuations. So that's exactly what we're going to continue doing inside our investment community, exploring unique opportunities that retail investors don't really pay attention to in the search for alpha. The investment universe is large and deep, and it has more opportunities than just the headline stocks. I'll also be proactively updating our members with thoughtful China risk-reward commentary after Alibaba's large recent move from 80 to 100, which we talked about on the channel and in our private community. Now, more thoughtful dialogue will be discussed on Twitter and Instagram at Larry Chung CFA. Now, make sure to join me in Substack along with my other friends on the platform. I expect this earnings season to be challenging, but I will help our friends navigate it. So protect yourself from what's coming up ahead. Thank you to Dashlane for sponsoring today's video, and I will see you guys in my next video.